The Federal Reserve actually hasn't pushed monetary policy pedals as flat to the floor as most other advanced economy central banks have. Unlike the Bank of Japan and the European Central Bank, the Federal Reserve hasn't taken its principal cash rate into negative territory. For what it's worth, I think they've been wise to do that. I don't think there's any evidence that negative interest rates work in Japan or in Europe. And indeed, if they did, then you might have expected that the Bank of Japan and the European Central Bank, both of which went into the pandemic with negative cash rates, would have made them more negative, which they conspicuously haven't done. Nor, interestingly, has the Federal Reserve done as much quantitative easing, that is, creating money electronically to purchase government bonds and other financial assets, to anything like the same degree as the Bank of England, the Bank of the European Central Bank, or especially the Bank of Japan has done. But obviously, the Fed being custodian of the financial system of a much bigger economy than, for example, Japan, has had a bigger impact on global financial markets than the BOJ's quantitative easing has done. But it is nonetheless, as I say, notable that in aggregate, they haven't done as much as central banks in other countries have done by way of attempting to stimulate ongoing economic and employment growth. Maybe that's one reason why greater weight is falling upon fiscal policy in the United States than in some other countries. People often ask why this ultra easy monetary policy hasn't led to higher inflation in the way that some people think the textbooks say that it should. People who say that the Fed is printing money and that's bound to lead to higher inflation and a collapse in the US dollar, are usually thinking about historical examples such as Weimar Germany in the early 1920s, or more recently in Zimbabwe under Robert Mugabe, or in Venezuela under Hugo Chavez and now Nicolas Maduro. But in fact, if we look in a bit more detail, what we see is that although the Fed has certainly been creating rapid growth in base money, and more recently in broader measures of the money supply such as M2, that hasn't been flowing into purchases of goods and services in a way that would in turn create a situation of, as Friedman famously put it, too much money chasing too few goods, that in turn is the basis for the emergence of hyperinflation in the examples that I mentioned before. You can see, if you look closely at this chart, that during the financial crisis, the monetary base, that's essentially the liabilities of the Federal Reserve and the currency in circulation, rose very rapidly by more than 100%, but it didn't result in an increase in broader measures of money such as M2, because the Fed was seeking to offset the collapse of the banking system, which meant that the banking system during the financial crisis simply wasn't capable of converting base money into money that could in turn be lent to households and businesses. Indeed, what the Fed was trying to do was to avoid the mistakes that the Fed made in the early 1930s when it stood idly by as banks collapsed, as the money multiplier collapsed, and that was really what put into the Great Depression. Ben Bernanke, who was chairman of the Federal Reserve during the global financial crisis, had previously spent most of his academic career studying the mistakes that led to the Great Depression and which made it worse. And famously, on Milton Friedman's 90th birthday in 2002, I think it was, acknowledged the role that Friedman had played in exposing the monetary policy mistakes of the Federal Reserve in the early 1930s and promised him that they wouldn't do it again. And Bernanke kept his promise. The Fed conspicuously avoided, during the financial crisis of 2008-9, making the mistakes that the Fed had made in the early 1930s, and quantitative easing was the main method of doing that. Of course, in the most recent situation during COVID, the banking system hasn't been dysfunctional at all. It has been perfectly capable of turning the increase in base money that the Federal Reserve has been engineering into a greater capacity to lend if there were demand for credit. But because there hasn't been demand for credit, because households and businesses either haven't been able to or haven't wanted to go out and spend, instead that rapid expansion in M2 has found its way into inflating the price of financial assets like stocks, and to a lesser extent, the price of assets like real estate, whose prices don't really get into the CPI directly, particularly in the way that the US measures house prices. So to put it a different way, in the language of monetarists, the increase in the supply of money as measured by M2 has been more than offset by a collapse in the velocity of money, that is the speed with which money turns over in order to fund spending on goods and services. Instead, as I say, it's gone into increased asset price inflation. Now, of course, in theory, it's possible that at some point, if households and businesses really wanted to ramp up their spending, they could take all that M2, that is, borrow more from banks or withdraw deposits from banks and spend it, and that could conceivably result in an acceleration in inflation at some point if the Fed didn't promptly unwind its quantitative easing measures and start to raise interest rates.